In this video, something big is brewing. Tesla may be about to shock the investment world, and things could get real messy real fast. So consider this a warning. And before we get into it, if you want to instantly unlock over 100 exclusive videos, plus my 10-year Tesla stock price targets and loads of other perks, including optional access to my Tesla valuation model, join our growing community of thousands of supporters on Patreon with the link in the pinned comment. You can also pick up some Tesla, Elon, and investment-themed merch in the merch store. Approximately 3 months ago, Musk was also asked how Tesla plans to use its capital in coming years. The CEO said, "Can you guys please stop calling him the CEO? He's a techno king of Tesla, formerly the CEO. Get it right." The techno king of Tesla said Tesla will primarily increase its capital expenditures and research and development spending, quote, "as fast as we can do without wasting it." He added that a sort of share buyback is possible depending on what Tesla's future cash flow looks like. Musk, who is also the CEO of SpaceX, said, quote, he wouldn't want to commit to Tesla share buybacks just yet, and that a force majeure event somewhere could change the equation. However, he reiterated, if Tesla's future cash flow is looking solid and the world is relatively stable, then a, quote, share buyback is on the table. Tesla's future cash flow looking solid AF. However, the world at this point in time, anything but stable. However, some recent developments seem to signal a possibility that Tesla's incrementally moving closer to the eventual share buybacks. This would be hugely bullish news for the company, a big swinging dick moment. And for what it's worth, at these levels, I mean, holy bro. Tesla, if you're watching, seriously, a few tens of billions of dollars into your own stock ASAP. I'm begging you. If my pockets were deep enough, I'd be doing the same. Unfortunately, I do have slightly larger fish to fry at this point in time. As I've mentioned previously, I personally believe at this point in time, Tesla stock is spring-loaded to say the least. Now, I don't know when that tension is relieved, but I do expect at some point, people are going to be wishing they had bought the dip. The Twitter overhang still continues to impact Tesla, macroeconomic environment, interest rates heading up, people freaking out, panic, fear, uncertainty, and doubt in the stock market. Some of these things to resolve sooner than others. This may be the straw that breaks the camel's back. So why are we talking about a potential Tesla share buyback? Credit rating upgrade at last, of course, not from the clowns over at Moody's. No, instead, S&P. Let's read the S&P Global Ratings update. Research update. Tesla Inc. upgraded to BBB from BB+, as in their credit rating. It's gone from junk to investment grade in this single upgrade. On improving production and solid cash flow prospects, outlook stable. Now, the timing of this is a little coincidental. I'm sure many of you watching will be familiar with the recent back and forth, the debacle around Tesla's credit rating, especially the clowns over at Moody's. Special shout out to Alexandra, aka Tesla Boomer Mama. It's possible that this may have got the attention of at least one credit rating agency. Alternatively, possible that Tesla is setting up to shock the investment world with a share buyback sooner than anyone could have predicted. We'll talk more about this in just a moment. As we read through this article, we get a behind the scenes peek into the new thoughts around Tesla from S&P. It appears they've taken a second, much closer look at the company and realized Tesla is a money printing machine with a truly dominant lead. Now, they may have taken this second look into Tesla of their own volition, or through sheer embarrassment and fear of being roasted by this guy on YouTube. After all, I've already completely barbecued the faces over at Moody's. Maybe S&P didn't want to be the second pile of corpses I leave in my wake. Or possibly, and I think more likely, in fact, almost certainly, honestly, I don't think the people at S&P or Moody's are busy watching some idiot on YouTube, because if they did, they wouldn't have such farcical credit ratings on Tesla. So the far more likely scenario, in my opinion, Tesla went knocking on the door and said, hey guys, thinking about doing some share buybacks here. You want to take a second look here and give us some of the finance to actually do that? Unfortunately, this tends to be how the world works. Should Tesla announce a share buyback, this will shock the investment world. It won't shock many of us, but it will shock the wider investment community. The only reason a company does this is A, because they believe their stock is currently dirt cheap, and or B, they believe their future cash flow prospects are so strong they can afford to do everything they need to in terms of R&D, spending, investment, scaling up, everything, and still have such an abundance of capital available that they'd be morons not to start buying back their own shares, aka investing in their own stock. Now, if you're a Tesla shareholder, share buybacks matter a lot. Why? It's the opposite of dilution. Instead of Tesla issuing new shares and diluting all existing shareholders, if Tesla's buying back shares, they're taking supply off the market. There's less shares available. This, in essence, enhances the value of the existing Tesla shares. There's less of them publicly available. When the world appears to be falling apart, when there's fears of recessions just about everywhere, and legitimate fears I might add, when many of the investing geniuses out there are fearful of a recession causing a total collapse in new vehicle sales, especially premium sedans and premium SUVs, which is what Tesla makes, because they're just cars. Were Tesla to announce a share buyback in the coming months or quarters, that spring-loaded stock may, well, I'm not going to finish that. You guys can fill in the blanks. This could become the perfect storm. So as we continue through this article, it's important to understand the changing perceptions. Prior to this, these guys, S&P, rating Tesla's debt as junk, as in don't even fucking touch it, super high risk. And it would be very awkward to mention the current credit ratings for all of the legacy automotive manufacturers, so I won't even bring that up, it'd just be too easy. So something's changed, big time. Tesla's reported production and deliveries for the 9 months ending September 30th, 2022 were higher than our expectations. Imagine that, somebody underestimating Tesla again. And the ramp up in its global capacity appears on track to meet the strong demand for its products into 2023. We now view Tesla's credit profile more favorably because it continues to demonstrate market leadership in electric vehicles. So the competition didn't come after all. With solid manufacturing efficiency that supports strong EBITDA margins and sustained positive free cash flow above our previously upside triggers. That's right, above the upside. Everyone continues to underestimate Tesla, and it won't be the last time. We raised our ratings on Tesla, including our issuer credit rating and issue level ratings to BBB from BB+. The stable outlook reflects our expectation that Tesla will maintain low debt levels as it sustains its solid market share, profitability, and strong liquidity. I mean, I can't believe I'm reading this from a credit ratings agency. They're finally starting to get it amid a weakening economy and increasingly competitive environment for EVs. Rating action rationale. Tesla's year-to-date production and deliveries indicate solid execution on capacity expansion to support strong demand for its products amid ongoing supply disruptions. In the third quarter, Tesla produced more than 365,000 vehicles, taking its year-to-date levels to nearly 930,000 vehicles, up nearly 50% year over year, on track with its average annual growth target over a multi-year horizon. Now, I just have to take a moment here. Tesla has publicly stated this, and this is their own terminology, sustaining approximately 50% or above annual rate of growth over a multi-year horizon, with some lumpiness along the way. Either S&P has been talking to Tesla investor relations, or vice versa, or they've actually taken the time to read through Tesla's prior statements, compare them to reality and performance, and go, oh, fuck, they keep doing what they said they were going to do. Maybe we should trust them this time. I suspect there's been some communication between S&P and Tesla, again, relating to the potential of a share buyback. We see in this update from S&P, they're now using Tesla's own terminology to describe their execution, rather than imposing their own views. Well, the competition will come. They're going to lose market share. They won't meet their production targets. Finally, getting credit where it's due and being taken at their word. Something big has changed. This happened despite production suspension in China during the second quarter. Shout out to the fascist shutdowns. Component shortages, parts inflation, and disruption to logistics. As a result, we now expect Tesla to sell 2 million units in 2023, above our prior upgrade trigger of 1.5 million units. Just want to emphasize this. I can't miss the opportunity to barbecue these morons. In 2021, they thought Tesla would produce just 1.5 million vehicles in 2023. Despite the Shanghai shutdowns, they're going to come in around 1.4 million units in 2022, having lost about 100,000 units of production due to the shutdown and re-ramp in Shanghai, meaning S&P off by an entire year. Talk about embarrassing. This will help sustain its solid market share within EVs amid intensifying competition and aggressive launches by automakers globally, particularly in China and Europe. Both the pace of production growth and the level of manufacturing efficiency, notice this, they're understanding Tesla's competitive advantage in terms of manufacturing in its Austin and Berlin facilities, with no material cost overruns, have been better than our prior expectations. Once again, everyone underestimating Tesla. Surprise, surprise. This positions Tesla well for the production ramp-up of its future products, including its Cybertruck, which is currently planned for Austin production after the Model Y ramp-up is complete. The battery electric vehicle market still remains a sliver of total US auto sales at under 7% of total light vehicle sales for the first 9 months of 2022. Tesla's market share within the electric and plug-in electric vehicle segment in the US was about 51% in the first 9 months of 2022. Lower shares in Europe and China. Its global market share for battery electric vehicles in the same period was around 18%, according to EVvolumes.com, and we expect it to remain in the 15 to 20% range over the next 2 years. Our improved view of Tesla's business supports its prospects for solid and sustainable free cash flow over the next few years. In 2022 and 2023, we expect Tesla to sustain free operating cash flow to sales of over 10%, compared with our prior upside trigger of, wait for it, 2%! Dude, it's so embarrassing. They're off by a factor of 5. They're not expecting 3% when they were previously setting an upside trigger at 2%. It's not 3%, which would be a 50% increase over their estimate. It's not 4%, which would be double. It's not 8%, which would be quadruple. It's 10%. Holy fuck. And there are still people out there today in the investment community with these types of absurd, massive underestimates for what Tesla will actually do. Backed by industry-leading EBITDA margins of roughly 20% compared with our upside trigger of 18%, and well above our 10% threshold for above average margins for automakers. This is despite high expenses related to the ramp up of its Berlin and Austin manufacturing facilities, ongoing supply chain disruptions, and rising commodity costs. So far, Tesla has partially offset the effects of the disruption with higher average selling prices, sale of regulatory credits, and lower manufacturing costs compared with our prior expectations. Once again, admission, we massively underestimated Tesla again. For instance, advancements in its manufacturing processes. Oh, here we go. They finally figured out the gigacasting. Round of applause to S&P. Good job, guys. Advancements in its manufacturing process, including large castings, enabled Tesla to reduce body welding robot count by 70% per unit of capacity in its new factories compared to its first iteration of the Model 3 body shop. Man, this is so close to Tesla's own terminology. They're either copy and pasting out of Tesla's quarterly reports, or they've been talking to Tesla directly. Let me know in the comments below, what do you guys think? Has Tesla been helping S&P to figure out their business? Spoon-feeding them some facts that others have kind of been talking about for years? Or did S&P decide, let's spend a little bit more time looking a little bit closer at Tesla and just scour all of their reports and realize that they were saying things that were playing out and now they're just copying and pasting things that Tesla was saying? Beyond 2022, key drivers for sustaining its high EBITDA margins include further innovations to reduce the cost of manufacturing and operations. Fair point, absolutely true, and we certainly will see these. Securing long-term battery component supply, especially lithium, also true, and also something we know Tesla's been working toward. Huge long-term supply contracts, multiple lithium companies, even potentially getting into the refinement and or extraction process themselves. And the acceleration of software-related profits. Man, they're nailing it on the head. They've finally woken up. It's amazing. Solid technological capabilities and an expanded range of affordable products will be critical as the global economy weakens and EV competition intensifies. Tesla's scale, scope, and diversity of products is still limited, around 1.5% market share relative to the global light vehicle market, which is estimated roughly at 80 million units for 2022. To sustain recent strong growth, hold its first mover advantage, and improve market share, Tesla will need to make the total cost of EV ownership more affordable, including insurance and service costs. Funnily enough, we know Tesla making massive inroads in terms of service costs and insurance, and driving the cost of EVs down. I swear, S&P have been talking to Tesla. Not that they needed to, but until this point in time, they couldn't figure it out themselves, so I have a funny feeling there's been some conversations directly between S&P and Tesla here. Why would that happen? Hello, issuing debt, upgrade, debt from S&P, use that debt, share buybacks, winning. Of course, I am just speculating, but it is informed speculation. The timing for its goals to improve the affordability of its vehicles will be an important consideration for our market share assumptions and for potential improvements in its competitive advantage beyond 2024. Remember that date, 2024? Robotaxi. They've been talking to Tesla. We expect a positive impact on its sales once the Inflation Induction Act takes effect in January 2023, as its vehicles could re-qualify for tax credits to EV buyers, up to $7,500 per vehicle. The Inflation Induction Act could also benefit Tesla through some subsidies specific to producers of cells and battery modules and packs in the US. Also true and extremely significant. Also a total waste of money, but as a Tesla stock investor, I'll fucking take it. To enhance its competitive position, Tesla will need to expand its range of products to contend with a substantially higher number of models from established global automakers and startups by the end of 2025. For instance, according to S&P Global Mobility, the BEV model count in North America will exceed 100 by 2026, over 4 times higher compared to 2022 levels. This includes nearly all large global mass market and luxury automakers, as well as startups. Over the next 3 to 5 years, a few of these could be... I love this. They've finally woken up and can see reality. Over the next 3 to 5 years, a few of these could become formidable competitors for Tesla. A few could, not all will. Big difference. This is because many have the capacity and the vertical integration capabilities. They don't have any vertical integration yet, but they are capable of vertically integrating to bridge the cost gap over time and leverage their existing customer base and brand to command pricing power. For Tesla, its autopilot and full self-driving technologies could sustain and improve its competitive advantages as it continues to make progress developing its FSD capabilities and remotely updatable artificial intelligence software. Holy fuck, guaranteed, game over. I've gone from 99.9% to 100%. They definitely talked to Tesla. They just called Tesla software artificial intelligence, which is accurate, but it's miraculous that they finally figured this the fuck out. I guarantee. Tesla's been spoon feeding them. They're on the phone. Hey Tesla, what's going on? Can you please explain? Okay, artificial intelligence, open wide. That's right, that software that's driving those cars, that's AI. The implications are very profound. Tesla's strong liquidity, begging for an inappropriate joke, and our expectations for a conservative financial policy add cushion to the BBB rating. With over $18.3 billion in cash and cash equivalents at June 2022, and our expectations of solid cash flow at least through 2023, after which point Tesla's cash flow could definitely possibly collapse. Not. We believe Tesla will maintain its strong liquidity. These levels are well above our established threshold automotive cash balances of roughly 15% of sales for Ford Motor Co. and Government Motors. Two peers, get fucked mate, they're not peers, that contend with industry cyclicality. With more cash on its balance sheet than total debt, by miles, Tesla appears easily able to fund its global expansion while navigating industry supply chain and logistics related bottlenecks that will persist into 2023. Nail on the head. Once Tesla's growth rate slows with the advent of more competition, we believe its financial policy and balance sheet flexibility will eventually face the harsh test of industry cyclicality pressures inherent in the auto industry. Not so sure about this. Specifically, we will monitor Tesla's plans for shareholder distributions. Hold up. We believe its financial policy and balance sheet flexibility. We will monitor Tesla's plans for shareholder distributions. Hello, share buybacks. We will monitor potential share buybacks. Curious, they're mentioning this quite explicitly. Potential growth of its captive finance operations or other business segments and tuck-in acquisitions. These may represent a larger cash outlay over the next few years than we incorporate in our base case. We risk adjust our assessment to incorporate these significant future uncertainties in addition to a slower than expected rate of EV adoption and the coming fierce contest with several very capable global auto manufacturers. The stable outlook reflects our expectations that Tesla will maintain low debt levels as it sustains its solid market share, profitability, and strong liquidity amid an increasingly competitive environment for EVs. Downside scenario, make sure you're paying attention. We could go lower. We could lower our ratings if Tesla adopts a more aggressive financial policy with respect to shareholder distributions, aka share buybacks and or dividends. The very first point on their downside scenario, it's almost as if their spidey sense is telling them it's possible Tesla may in fact be making some decisions relating to expenditure of some of their excess capital with respect to shareholder distributions, dividends and or buybacks. Growth of its captive finance operations or other business segments and acquisitions such that financial cushion reduces materially, or it cannot sustain solid free operating cash flow due to slowing growth or higher than expected spending. Upside scenario, also worth paying attention to. We could raise our rating if Tesla sustains its first mover advantage as EV demand expands and competition intensifies such that its global light vehicle market share appears likely to exceed 5%. Bro. Oh, it will exceed 5%. And 10%, probably 15%, and maybe even 20%. Remember they were talking about their previous upside scenario and they're estimating 2% and Tesla's at 10? We're going to see an exact same example of this, them being off by multiples. Not just 50% or 100%, but 200, 400+%. Or it appears likely to sustain its recent track record of free cash flow beyond 2024. Hello, it will. I mean, what? And it remains committed to a prudent financial policy in line with a higher rating. Company description. Tesla is the world's leading manufacturer of fully electric vehicles with a market share of 18% during the first half of 2022 and a major producer of energy generation and storage systems. As of the first half of 2022, Tesla has an overall market share across the global light vehicle market of 1.5% with revenues likely to exceed $80 billion in 2022. Agreed. Our base case scenario. Global GDP grows 3.1% in 2022 and 2.4% in 2023, mostly due to higher inflation, with some recovery in 2024 to 3.2%. the risks around this baseline remain on the downside. Despite tough global macroeconomic conditions, growth in electric and plug-in hybrid vehicles is resilient, with a global share of at least 25% by 2025 and a US share of 18 to 23% by 2025, compared with our prior forecasts of 20% and 15 to 20% respectively. Global market share is 2 to 4% as a percent of overall light vehicles by 2025, compared with our 1.5% estimated for 2022. Tesla's annualized EV production and delivery run rate supports over 50% volume growth in 2022 and exceeds 2 million units of deliveries over the next 12 to 18 months. EBITDA margins are 18 to 21% over the next 2 years, which we consider well above average relative to peers. Tesla has no peers. Capital expenditures are around 10% of sales. Our projections of key financial metrics, zero net debt, and annual free operating cash flow to sales of over 10% in 2022 and 2023. Liquidity. We assess Tesla's liquidity as strong and anticipate its sources will well exceed our threshold of 2 times uses over the next 24 months, even if EBITDA declines 30%. We assume adequate protection against potential execution missteps or inefficiencies related to production and supply chain management, as it manages working capital swings related to the logistics of global deliveries, as well as increased production of Model 3 and Model Y. Principal liquidity sources. $18.3 billion, that's billion with a B, of cash and cash equivalents, and about $2.4 billion of unused committed amounts under credit facilities as of June 30th, 2022, some of which is subject to satisfying specific conditions. Annual funds from operations of $20 billion to $24 billion in the next 12 to 24 months. Again, I just cannot believe I'm reading this. They're right. Principal liquidity uses. Capital spending of $8 to $10 billion over the next 12 months. ESG, the biggest scam of scams. Environmental factors are a positive consideration in our credit rating analysis of Tesla. The company has an advantage over competitors given its battery and powertrain technology, the superior range per kilowatt hour, geez, they really are figuring it out, of its vehicles compared with upcoming launches from competitors, and lack of internal combustion engine vehicles, which are under increasing scrutiny from regulators globally. Governance is a moderately negative consideration reflecting past misconduct relating to securities fraud charges by the SEC and the high rate of senior executive turnover. Despite comprehensive corporate governance and other reforms at Tesla, we view key person risk as very high for Tesla, given Elon Musk's dominant role in the company. Fair point. Social risks are currently a neutral influence, but are likely to intensify in the next decade because potential accidents, autopilot underperformance, fires, headline risk, and cybersecurity breaches could increase the risk of product liability, government scrutiny, and further regulation. Until those risks subside, we believe Tesla's progress toward improving safety by successfully deploying its autopilot technology will at best remain credit neutral. Now a quick bit of nerdy finance stuff. Issue ratings. Subordination risk analysis. Capital structure. Tesla's $4.4 billion of reported debt as of June 30th, 2022, which mostly comprises automotive asset-backed notes and financial leases. We expect the company will proactively refinance or repay its minimal upcoming unsecured debt maturities, given its strong credit standing and available cash and cash equivalents, which totaled over $18 billion as of June 30th, 2022. And finally, analytical conclusions. We rate Tesla's senior unsecured debt BBB, in line with our issuer credit rating, because its debt is low enough to limit the possibility of any lenders being significantly disadvantaged relative to other lenders. Rating scores snapshot. BBB, stable. Business risk, satisfactory. Country risk, low. Industry risk, moderately high. Competitive position, satisfactory. Come on, you fucking idiots. Let me fix that for you guys. Much better. Competitive position, dominant. Unassailable. Financial risk, modest. Cash flow and leverage, modest. All I have to say is it's about fucking time. Out of absolutely nowhere, S&P have completely flipped. Woken up, smelled the roses and thought, you know what? That smells like a money printing machine with an unassailable lead. I got a real funny feeling, based on what we're hearing from S&P, they're talking in Tesla's own words, describing things that are accurate, true, and extremely obvious, yet previously they'd all been ignoring. I personally believe the most likely explanation is that Tesla went a knockin', yo S&P. We're thinking about doing some share buybacks. You want to have another look at our credit rating? You can finance it. Win-win. S&P said, oh, did you say money? Money? Yeah? Oh, of course we'll look at your credit rating. Of course. They've then taken Tesla's credit rating out of the pile of companies that haven't paid us shit, so we're not going to do anything, to companies that might be paying us a shitload of money, so maybe we will do something. Of course, this is pure speculation, but I think it's fairly well founded. So, long story short, moral of the story, Tesla announces a share buyback in the near term, the next few quarters. 1, I personally won't be surprised at all, and 2, I think the stock market will be very surprised. The stock market is surprised. Tesla delivers an enormously bullish signal. I wonder what might happen to Tesla stock. Something to consider. Hope you guys enjoyed girls have enjoyed this video. It's very important to see some of the dinosaurs finally starting to wake up and see the reality that's been there and available. They've just had their eyes closed for years. By the way, guys, another heads up, posted more exclusive content before I posted this video to YouTube today. If you're not on Patreon, you really are missing out. Well over 150 exclusive videos. If you're not already part of the community, you can join by clicking the card in the corner or the link in the pinned comment. I'll see you over there. I'm Stephen Mark Ryan. This is Solving the Money Problem, and I love you all. Hey guys, thanks for watching. If you want to support the channel and instantly unlock over 100 exclusive videos, plus my 10-year Tesla stock price targets and loads of other perks, including optional access to my Tesla valuation model, join our growing community of thousands of supporters on Patreon with the link in the pinned comment. You can also pick up some Tesla, Elon, and investment themed merch in the merch store. And if you're still watching, you're awesome. Please let me know your thoughts on today's video in the comments below and click the card on screen now to watch the next video.